Good evening, everyone. We are live from Chicago. Today is Thursday, April 11th. I'm Charles Brown, Portfolio Manager with CB3 Financial. We're glad you are with us tonight. Well, the raging bull continues, and we'll talk about first quarter earnings. Second quarter earnings start tomorrow. But first, did you see it? So tell me, did you see it when it went overhead yesterday? Actually, it was Monday, right? Get my days correct. So here I am protecting my eyes, watching the sun and trying to eclipse first quarter performance with the solar eclipse. Hope you guys got a peek at it and enjoyed it. But tonight we're going to be covering a lot of different topics like we always do. If this is the first time you've watched the program, please subscribe to us on YouTube. Click the little bell so that you get notified whenever we go live or whenever I upload a video. And also, I recommend that you follow me either on X or Facebook or LinkedIn. I have a pretty good audience on all three channels. I tweet every single day, sometimes twice a day, but that's, rare, I suppose. But the main thing is that we're staying in touch with you. That's what we do. And in fact, here are the topics tonight. The normal that you see, monthly market report, U.S. policy, the Fed, employment, inflation. Longer than normal section on inflation because the CPI report Wednesday kind of blew everybody out of the water. Economic indicators, AI, will review our portfolios and handle some questions that you guys sent in. Always would encourage you to send in questions. We have that questionnaire going out in email. Hope you guys aren't getting too many emails, but we like to send a reminder a week before the show, and then the Monday before the show, and then today, the day of the show, and then the Monday after, so that you guys can ask questions that I can then handle in the next month's issue. So there we go, 4 emails a month. It's not terrible, but that's what we're doing. So the monthly market review, as you well know, stocks have been on a tear this year. It's been about, except for the second quarter of 2020, the best quarter performance for CB3 programs since 2020, and maybe have to go back to 2011 or 2012 to see this kind of performance. It's been great. S&P up 9.1%. That's off the highs, but still quite good. All right, best first quarter performance since 2019. You guys have seen this chart many, many times. We are continuing in the secular bull market. I believe that this is going to be with us for a while. I've been saying that. I have not varied from that. I think we've got maybe 8 to 10 more years, not months, years of the secular bull market. We will have dips, and you saw them in there in 2020. You saw them back in the previous, bear market. It looks like a tiny blip right now, but everybody remembers 1987, the worst single day in the stock market history. But you're going to see, I believe, another 8 to 10 years of this. So why am I confident? Well, I'm going to walk through what's really in play right now. Quarterly earnings, even though they are not as impressive as they were back in 2021, 2022, even the beginning of it. And that was because we were coming out of COVID and trying to get out of the doldrums, and successfully did that. But the estimates are still positive. So 3.2% for first quarter 2024, which again, those will start reporting. Well, we've had 20 stocks you'll see later on in this segment report already, and those look good so far. But it's when the banks come out, the big banks, that really the previous quarter's earnings get kicked in gear, and that'll be April 12th, tomorrow. So PE ratios next 12 months, predicting pretty good, even though on the left side, that's why I put these together. On the left side of the graph, you see it's been kind of tame, but look at the up trajectory here for PE ratios over the next 12 months. And when price earnings ratios are going up, that means that if the companies are telling you the truth about how their earnings are going to go, that you're going to see stock prices rise too. And that's a good thing. And we are in an election year, and that helps us as well. So this is a summary from Wednesday, not today, but yesterday, highlighting the outperforming areas. So yes, yesterday it was a pretty ugly day because the market was thrown by the consumer price index being just 0.1% higher, but any little unexpected jolt like that, again, you've heard me say so many times, market players don't like surprises, and that's what we got yesterday. Today was pretty much in line, the producer price index, but here's what I'm pointing out on this chart. Where do you see that the beat up really happened? In materials, which is down at the bottom, XLU, utilities, and real estate. So if those sectors are getting beat up, if the money's coming out of the market, that's one thing, but I don't think it is. I think it's rotating to the other sectors, and essentially you have big institutional players saying, we're going to dump the conservative holdings we have now, or at least some of them, and we're going to invest in the aggressive sectors. And that played out today with the NASDAQ hitting a lifetime high. Hard to believe, just a day after the downturn. So there's nothing here that's screaming to me that says get out. What I'm seeing is stay the course. So I've heard over time, and I've shown this one other time, but I want to do it again, that there is a concentration of stocks. It'd be great if each stock in the S&P 500 had a 1 500th weight, if you know what I mean, equally weighted. And there is an equal weighted index, but we don't use it because it doesn't really matter. The top biggest companies are what move the market, and so we have to weigh them accordingly. And you can see that over time, and we can see we're right here at 2024, the market cap of these big stocks, 33% of all the S&P returns are coming from the biggest stocks. And on the right side, the largest stocks have been the major drivers of the S&P returns in recent years. You can see the 10 largest stocks are in dark, and the rest of the S&P is in light. So we can get over the fact that the 10 or 12 biggest stocks are driving profits. And why can I say that? Well, all you have to do is look at the Magnificent Seven, which started off like on fire in January and is the least well performing of our three programs right now, although it's still quite good. But what you're seeing and what I call this is rotation. We're rotating from the mega trillion-dollar companies to the rest of the market. That is good. We want to see healthy rotation into all 11 sectors, even the conservative ones in the S&P 500. So 1 year after each new all-time high, and I've lost track now, I think it's 19, the last time I checked, 19 all-time highs so far, and we're only at April 11th, okay? And actually we had one in the NASDAQ today, but what we really count is what the S&P does. So a year after that, stocks are up 15.3%. After 2 years, that average climbs to 23%. So sometimes you can look at these kind of stats and your eyes just gloss over, but here's the thing. Historical performance does have some credibility. It doesn't mean that's the way the market will perform, but it does mean that that's how it has performed once it's gotten momentum. Everything on this chart is showing you is momentum. Once things get going, how long can the rally continue? And that essentially goes back to how long can this secular bull market continue? Based on the last 100 years, we've got another 8 to 10 years, not 2 to 3. Now, I may be wrong and it may only be 7 or even 6, but it's not 2 or 3 if history is going to play out like it has the last 100 years. And the 100 years before that, there was not much trading being done. Okay, makes sense? So you guys have seen this chart. We've only had 20 stocks reported, 480 still to report. When I do the May show, there'll be a ton more up here, probably about 350. And we're still seeing, nice off the bat financials, all industrials, all technology have beaten their earnings estimates. And of course, tomorrow, the big banks, JP Morgan, Citi, and Wells Fargo will announce their earnings, and we're waiting for that. Watch for my tweets. I'll be keeping you guys up to date on that. If you have questions, just put them in the chat. Okay. Hey, Doc from Cincinnati. Hey, Hossein. Hello, Martha from Upper Michigan. Hope you're doing well up there and not having any more snow. I like seeing people from around the country. This is great. Thank you guys for watching tonight. So as you know, U.S. policy is what counts, but politics is how it starts. And raise your hand if you like politics. Good thing none of us can see each other's hands, right? None of us probably, I can't imagine, really enjoy politics, at least in the U.S. But that's how we get policy, and policy does affect us at a personal level and at a portfolio level, and that's why I have to talk about it. This is a new topic, and it's the only topic I'm going to do in this section tonight. Never covered this. Dark money. All right, so why is this important? Well, because policy affects how investments are made. It affects how American business allocates capital towards growth. So you can't just say that it doesn't matter who's president. It doesn't matter who controls the House or who controls the Senate. And I'm not talking about the social issues. That's a separate issue, no pun intended. But the reality is it affects us as investors. So I just thought that you should know that this is how this works. So there's secret money basically in the political process, and it, I think, deprives voters of the information necessary to make informed choices about our electoral system. Remember, we don't elect presidents by popular vote. The popular vote flows into the Electoral College, and the winner of 270 votes is the next president. All right, but it's vulnerable to corruption and manipulation. I'm not telling you anything you don't know, but why is this the case? because these donors, and you can see I used a black question mark there, go into that. They can't just contribute to the candidates because there are federal limits on that, but they can contribute to these 501c3 and 501c4. Yes, there is a 4. All right. And then those entities acting on behalf of the donors, and if you really believe that they're seeking what the donors really want, yeah, I don't know about that. All right. And that's how ads are bought. Newspaper, a lot of social media, a lot of TV. Okay. So most political groups are composed of this mix of 501c3 and 501c4, and they're registered with the Federal Election Commission. Well, the FEC is in charge of keeping all these records. Here's the problem. Millions and millions and millions of dollars go into this entity. The FEC is a government entity. So how efficient do you think that is at keeping track of accurate tally of what's legal and what's not legal? And here's the issue. Look at the second paragraph here. And I've got a lot of data here, guys, and I've got several segments where there's a lot of data. And you can always go back and watch it. I've heard people say, you know what, just skim through this, and we're going to go back and watch it a second time. Well, I'm honored that you are. But look at the second paragraph. So the 2024 reports don't even need to be filed until the end of 2025. And we're wondering why. We're just now finding out what actually happened in 2020. Probably knew last year, 2023, but we sure didn't know in 2021, and that's because the reporting requirements are so lax and so cumbersome at the same time. So as the year presses on, more and more of these dark money organizations are going to plunk down huge sums of money on these hotly contested races for Congress and state contests too. That's just the way it's going to work. All right? So if you're interested in a little more of that, you can go to the FEC site and just type in dark money, and it'll say, well, can't really offer an opinion on that, but they will have information on it. This is what determines, and this is corrupt on both sides, guys. Anybody that wants to say that their party is not guilty of this is just simply mistaken. Okay? But what it is doing is depriving us, the American voters, of the most transparent election possible. And so when it affects your pocketbook, I got to talk about it on my show. All right. So the Fed, obviously in play. Everybody wants to know, when do we get our rate cuts? Well, many people were thinking that was going to be in June. Not so fast. I don't think so. Hey, Kay, how are you? Good to see you. Hello, Steve. Welcome. So, I'm sorry. Pal, we're not far from confidence, in the confidence needed to cut rates. He said that before the CPI report, okay? And then Janet Yellen, who is not the Fed chairman anymore, but the Treasury director, sort of backhoed on that the rest of the week once this report came out. But the reality is we are still seeing higher inflation, okay? And the Fed doesn't want to see that. This was the forecast for the Fed funds rate 6 months ago. Remember, they were talking about dropping it, and you see the little red line here, in 2023, so like halfway through the year. That didn't work, okay? And so now the market keeps expecting higher and higher, and the Fed is not budging. Well, does the Fed have to follow the public opinion? They don't, unless it's an election year and we're moving closer to the election and the party that's in the White House could really benefit from a rate cut. Do you think we might see one in August, September? October would be a little late, but yeah, that could happen. And if the first one's not until August, probably going to see another one the next month. Just my cynical opinion, okay? The Fed, cash flow wise, is in the biggest mess in 108 years. There's been no remittance to the Treasury. Why? Because they are paying so much interest on the debt and the Fed's asset liability mismatch. So the Fed owns assets on their balance sheet, and when they get out of whack, when they don't have enough money to pay for them, then they're represented as an unbalanced balance sheet. Okay? And this has not been this bad in 108 years. How long has the Fed been around? About 108 years. Okay, so this is concerning, but Doesn't seem to be getting much news coverage out there, but you've heard it on my show. There it is. So this will be the third time I've shown you this, but I just can't reinforce this enough. Look at this. The expectations of the media and traders and portfolio managers like myself and the actual effective rate. I'll get this. Guys, I got a little bit of a sore throat, and so I have a cough drop in, and if it's rattling around, forgive me, okay? Where you see the blue lines go up here is where the expectations are. Well, we're expecting raising, and it didn't move. It didn't move for a decade or more, actually. And then once it got real high here in 23, you see all the blue lines going, oh, it can't stay here. It can't stay here. It's got to go down. Well, they're just wrong. Whoever wants to say that they're calling where the Fed should be, they don't have the data the Fed has. And really, they're just, they're not using their intuition. They're using their intuition. See the difference? All right, employment scenario. So the good news here is, well, there was an eye-popping March jobs report. I mean, really, really good. The problem is that just means the economy's still going strong. And the problem with that is the Fed goes, if the economy's still strong, we can't drop rates. I mean, look at this red bar, higher than the last, you have to go back to May of last year, right? Before we had more jobs than this. Survey was for 214,000, came in at 303,000. Under most scenarios, that's good news, but not when the Fed is watching every single tick. I put these three on the same screen here because I want you to see part-time employment is what's rising. Now this, again, you don't see this in the media. I don't know why. The data's right here. I don't like seeing part-time employment surging because that means it's taking away probably a full-time job from someone who wants it. And the part-time employment as a percentage of total employment, look how it slammed down in 2020. Obviously, that's COVID. Same thing on the left chart. I mean, employment just went way down because of that. But now you see part-time employment as a percentage of total employment getting feisty. And I don't want to see that. But the reality is, go to the right channel now, or the right slide. Full-time and part-time, they've just diverged. The purple line is going right through the black one, and we're seeing more part-time people. Haven't seen this since 2020. So I'm watching this because what are the biggest factors that control how well the stock market does? Interest rates and earnings. Well, let's see, that'd be three if you've got employment in there. But employment, when people are working and spending, affects earnings. So really, there's still just two. But the earnings are driven by the people spending, and that's driven by how well they are employed. Okay, so that's a second derivative, so to speak. All right. According to the BLS, so the Bureau of Labor Statistics, the number of immigrants, legal and illegal, working in the U.S. grew by 3.4 million between Feb 20 and March 24, before the onset of COVID. Well, Feb 20 is exactly the onset of COVID. The number of U.S.-born workers declined by 78,000. And we're going to see this in a slide coming up on the population drop that's happening here in America. But what this means is that part of the reason we're seeing these jobs is because they're being filled by not U.S. citizens, but illegal immigrants. Now, I'm trying to do my best not to make this a political commentary, but it does affect and stretch the numbers in a way that does not accurately reflect what's going on to the native-born population of America. A closer survey shows that native-born Americans has been in decline, all right? The employment report has been in decline for 4 years. Pretty much means that all the job gains have gone to foreign-born workers. Well, we're glad that the money is being earned here and it's being paid tax on and income tax on and rents are being paid and food is being bought. But still, for the American worker, it's kind of concerning for me. You can take it however you wish. Inflation last few months, I've just had a couple slides. Tonight's got to be more just based on what we saw. So the summary is that the March CPI rose by 0.38%. Doesn't seem like much, but it's higher than was expected, okay? And the core CPI, remember, without energy and fuel, or food, I should say, rose by 0.36. So this super core inflation, the metric that the Fed most looks closely at, is accelerating at an alarming pace. Maybe I shouldn't use the word alarming. How about an irritating pace? It's not like it's jumped back up to 5.5, but when we all see this coming down, we just want to see that keep sustaining down. And it's just being stubborn. Now, I've shown you charts, not tonight, but a couple episodes ago, where we've had inflation peak like in 2008 and 1980 and come back down, but then it ebbs back up and then finally it goes back down again. That could be what's going to happen here. And it doesn't mean that it's going to derail the secular bull market. It just means that a really full recovery could take a little bit longer. And you say, then how did the NASDAQ hit a new lifetime high? And that would be a great question. The answer is because there's still FOMO. FOMO. Fear of missing out. And that's why people are buying right now. I'm not saying the fundamentals don't justify it. I'm just saying that despite the data that I'm showing you and that traders know is there, they're still buying. And that means when we work through some of these problems, which we will, the buying should really kick in at a serious level, in my opinion. All right. So what's the result? Another hot CPI print in March, that's 3 in a row, just buried the rate cut narrative. Well, buried it for June. I think it's going to be August. I think you're going to see August and September because it's an election year. All right. So the headline CPI coming in at 3.5, hotter than estimated. The core 3.8. I mentioned this. And again, you guys can go back and screen scrape if you really want to drill down into this. But here's the takeaway. The summary is that this 2% inflation target, which is the Fed's mandate. Remember, the Fed has two mandates. It's not like the ECB or the Bank of Japan or the Bank of England. They have two mandates. One, keep inflation to 2%, not 3, 2. It was 3% earlier in my lifetime, many years ago, but 2% now, and maximize employment. It's a dual mandate, right? Which I think is good. I really do. So the causes of inflation have evolved since the pandemic, with durable goods experiencing deflation while services and housing inflation, all right, even though it's been somewhat moderate. Now, this started during COVID, where prices were depressed on items because you couldn't get them. And then they skyrocketed when there was so much scarcity, and services, what people were being paid in restaurants and all that, plummeted because people weren't going out. So we see this imbalance between inflation on goods and inflation on services go back and forth. I track that because it doesn't mean what you're going to buy today is based on that particular datum. But going forward into the future, it's going to affect which companies, a service company or a product company, likely sees stronger earnings. Make sense to you? All right. So this is where I get a lot of this data. BLS. I know it sounds like BLT, but BLS. U.S. Bureau of Labor Statistics. This is the most recent report. You can see that 3.4 of it I mentioned. You can see food and energy. The component of that is well over 50% just on food and energy. And then you add up all the items, less food and energy. So that's why the government breaks it out there. But if you're really interested in inflation, there's a ton of fun data there. It depends on how geeky you want to be about it. Beneath the surface, though, I think it's pretty clear that this disinflation that I've been talking about for the last 6 months, if it's not dead, it's at least dormant. All right. And that's where I'm seeing this now. I'm not concerned about it. We've seen this cycle happen many times where it doesn't just have a perfect V-shaped recovery or an inverse V, which is what inflation would do, right? It would go up and then plummet straight down. It can come back up. So it's like a W correction. All right. We don't know if that's going to happen, but it's sure looking like it. All right. And there's plenty of precedent for it. So I wouldn't be concerned. All right. The Fed's biggest challenge is getting inflation down to 2%. It just is. And core CPI made this unexpected turn, and that's what riled the markets. And yet today, the producer price index, consumer price, producer price, that's the companies, actually surprised to the upside. Well, guess what happened? The buyers were just waiting. They weren't shell-shocked from Wednesday, were they? They were waiting in the trenches and they came in gangbusters, hence the lifetime high in the NASDAQ today. So anyway, I think probably I've got too many screens in here for this. You guys tired about inflation, but it's important. So the persistence of inflation is likely to influence the Federal Reserve's monetary policy direction. I mean, it's undoubtedly going to, particularly concerning when they do these rate adjustments. You have to mix that in with the fact that this is an election year. Once we get past that 25, should be based more on fundamentals. I slipped that up. Should be based more on fundamentals rather than funny mentals, which is what can happen during an election year. All right. Commodities have been strong. Those of you in the Spec Op program, I tell you, just crazy. Look at crude oil, gold, copper, outperforming the S&P. Those of you, have you seen the silver trade we have on? Like $6,000 on a one lot. It's pretty amazing. It doesn't mean that commodities are always doing well. Look back there in the first part of 2024, but right now they are doing very, very well. And we have a little bit of commodity exposure in the other programs too, but Spec Op is mostly where it is. Nonetheless, the protection that we do have in and we'll talk more about this at the end. You guys have heard this, but CG and GI have very defined risk management strategies. So if we have a downturn here coming up, the market just runs out of gas, we're not just going to sit there and get whacked. We will make adjustments. And you've heard how I do it, and I'll do more of it tonight. So this economic indicator section is important because it's not so much what's happening now, but the indicators that I'm looking at that I call that are 4 to 7 to 8 months out, not a year. It's kind of hard to do that, but 4 to 8 months out. So what am I looking at that raises an eyebrow? So when you see economic indicators on the screen, you could think, this is what's raising Charlie's eyebrow, all right? Meaning I better pay attention to that. So number one, small business optimism is at a 13-year low. I mean, I don't like that red dot down there. And granted, that's January data because we don't have February and March data yet. But the survey 89.9, the actual was 88.5. Not good. I mean, this needs to be above 100. That's where we want to see it. We had that spike in 2020, and it bounced back to over 100, dipped down, bounced back again. But then it's just consistently been dropping. I personally think that's because inflation has been nagging, and that hurts small business. Why? Because it increases their borrowing costs. So you just gotta be sensitive to that without a doubt. All right, next is credit card delinquency rates were the worst on record in this most recent Fed study. So 3.5% of credit card balances are at least 30 days past due. That is not like Russia, where it's about 10%, or other third world countries, South American countries, where you're like 13 to 14%. It's bad. But 3.5% in America is definitely concerning. I mentioned this earlier. The U.S. population has just been since 1960. Many of us on this call were born around that time. And it's just dropped and dropped. This is the percentage yearly growth. So we had and you'll see that on the chart when I flip it back, but I'm just pointing out that this does not help us on the world stage. Do you see China dropping in population? No. India? No. Not even Russia. So there are big countries out there that are not necessarily our best friends that are having a significantly higher percentage of new people come to the planet versus the ones that are passing away. So we have a little bit of a bump here to 0.5, but it was almost no growth in 2021. Again, I think that's COVID related, but that's something that I'm watching. NFIB hiring intentions. So if you look at the gray line, if you look at the orange line first, that's the payrolls as we see them. And that number, if we could extend that through March, because that just came out last Friday, that's very positive. But then you look at the expectation, and of course, that's why it goes all the way through to July. That's just plummeting. And if this is true, I don't know where the new jobs are going to come from. Now, that seems overly pessimistic to me, but I use this data point at least 4 to 5 times a year, maybe not on the show here, but I'm watching it going, if no more jobs are coming out, where's the growth going to come in these companies' earnings? Because who's going to be buying the widgets? Not so many people, right? Again, it doesn't affect our trading decisions today, but it does affect them going forward. So in the most recent report of FINRA, and that's our regulatory entity here, margin debt levels have surged as bullish investors have leveraged their bets. So margin investing is when you buy something with borrowed money, at least part of it's borrowed. So when you buy a house, you're buying on margin. It's never disclosed that way, but it just is. Anytime you don't pay cash for something, and I don't mean put it on your Visa because then you're presumably going to pay the Visa off at the end of the month, but any large item, any investment, any house, any asset, if you're borrowing money, you're buying on margin. Not necessarily bad, but many people that buy on margin, don't know what they're doing. And the increase in leveraging can come to a surprise for first-time people that are saying, I'm missing out. Remember that FOMO that I said? You can't forget that acronym, folks. FOMO, fear of missing out. And what happens, they'll go to their broker and say, I've heard of this thing called margin. Well, yeah, you can actually, how big is your account? $35,000. Well, we can actually loan you 35% on that, so you could buy $50,000 worth of stocks. Oh, okay, wow. Now you'll have to read this disclosure and understand what that means. Okay, I'll do that. All right. Now add, 6 zeros after that, and you're seeing this at the institutional level, but you see that margin percentage there. I didn't put the numbers at the bottom because it's too confusing, but people are pretty aggressive right now. And so even though I don't use it as a technical indicator for trading the markets, it does represent an amount of speculation that concerns me. All right, productivity growth has outstripped wage growth. Why do I care about this? We should be glad that productivity has increased, right? Okay, well, if the worker is not being paid for their increased productivity, this sounds like a class warfare issue, doesn't it? Sorry, that's a strong word. But the reality is, with unions still on the decline, workers are expected to produce more widgets. They are producing more widgets, but they're not getting paid for that productivity. I don't like that. Now, if I were purely a robber baron and, running just trillion-dollar companies, all they care about is, I'm sure, making as much as possible. That's harsh, but probably true. That's how they got to be so big. But this trend is not a good one, all right? And I will be watching this. The dotted line, of course, means how things look way down the road here in 2025, but we'll be tracking this. I'm going to stop and just look at questions. We got some lively dialogue tonight, guys. Thank you. And Keith, so bad employment numbers and bad financial reports help the markets go up, and good employment numbers and good financial reports make the market go down. Seems counterintuitive, and I get it. There is no consistent way that we can count on news to move the market one way or the other. That is what I've learned in 30 years of doing this. I wish there were a way, because if there were, everybody would be on that side of the bet and nobody would take the other side of the bet. And yesterday, I was trading the yen and the euro, and the instant that CPI came out, there was this huge long bar, just bam, and it didn't mosey down there. It just straight went down. There were no bids. There were no bids. And so when there are no bids, there's just going to be continued selling, all right? And that's just the way it works. There's no way to predict how a market's going to react to that. I hear you, though, Keith. It's crazy. John, there are forecasts out that show that the world population crashing to about, 5 billion, huh? From 7 billion now in about 30 to 40 years, based on worldwide birth rates overall. That's a huge drop. That would need participation. I mean, what the U.S. is doing here by its population dropping is kind of a speck on the map. Let's face it, China and India are really running the show, and just Asia in general, Eurasia, Asiana, I think is the word I should have used there. That's where the population is in the world. So if they drop, if people just stop having babies, it affects everything. I don't think it sends us into a crash. I think companies are smart and they will figure out a way to still make profits with less people buying. But I think that certainly we're headed towards less population growth everywhere, without a doubt. Thanks for mentioning that. So Anything else, guys? Just drop it in the chat box there, okay? So I don't know what you feel about electric cars. One of our children has one. Actually, two do. And we've looked at it. I'm a fan of Tesla. I'm a fan of Elon for sure. But I don't know if you saw this in the news. The latest quarter, Ford lost $14 billion on their EV cars. It's just crazy. And what people are finding, what the people in the industry are finding, is that consumers are concerned about range, reliability, convenience, and price. I don't even think it's price so much, convenience and range. Convenience and range kind of the same thing. So if you live in an urban area, probably not such a big deal. But they're more difficult to repair. You can get a Ford part replaced pretty much anywhere, and even imported cars now, because there's so many of them and they've had half a century of being driven on roads, that there are all kinds of places here around in Glen Ellen. You can probably go to 4 places within 1.5 miles to get a car repaired, a foreign car too. So, but that's a trend we're watching. So, and another one, again, this is all under the economic indicators. Americans are paying as much interest on all their other debt as they are on mortgages. This is kind of an appendage to the margin trading that I just talked about. People are having great bravado and willingness to take on more and more debt. They must feel good about how their future is economically. And yet you saw the small business confidence. So I'd like to see the small business confidence in sync with the consumer confidence. Consumers, as you know from years and years of listening to me speak, make up 67% of the economy. And then about 25% is the corporate America. And about 9%, I know it seems like more, is the government, okay? Just those three entities make up all GDP. But this mortgage burden still at a lifetime low, because people are spending so much more on interest for consumer products. And that's concerning. We're tracking it. We're following it. So, Dr. J, I think that India now has a larger population than China. I had read that change was going to happen in January or early February of this year. One-child policy with China that depressed their population growth, right? Yeah. And they literally would take the other child out, and who knows what happens to it if you were caught with 2 children. It's crazy. But they've got a different set of problems over there in China, and maybe India too, and that's how to provide for basically as third world countries and enormously growing population 10 years ago, which is now not the case. John's correct on that. So AI, a little different angle tonight. It's a little small type on here, but you can see it. 12 trillion tokens. A token is a datum for OpenAI, and you're starting to know these names. I hope that OpenAI is the founder of ChatGPT. They're all the way up to 4. 5 is going to be out soon. It's going to take 1 trillion tokens for training that GPT-5 language. And part of the problem is they don't disclose the details of that training material. So how this works is pretty straightforward. If you search the internet, you'll find data. It's not necessarily assembled in any kind of order. And that is the essence of what AI is. It grabs billions and billions and billions of bytes of data and assembles those in the way that a human brain would, and spits them back out to you. And literally every month or so, it's getting better and better at it. All right? And that's why it's going to affect the economy. Many people, of course, don't want to give over their private conversations, such as chats, etc. But the reality is that's going to happen at some point. Hossein, the U.S. is actually one of the countries with a growing population. Of course, and I showed that's about 0.5. It's small because of the new legal immigrants. China, Russia, and many other European countries are losing population. And that is true. We have the most desirable economy, culture, legal system, and chance for opportunity in the world. And we have had since well before World War II, but certainly since World War II, so we're closing in on 85 years here. And that's a great point, Hussein. Thank you. You guys are real active tonight. Thank you for typing in the chat box. This is great. Thank you. Thank you. So the maker of ChatGPT has 600,000 individuals paying. And you could say, well, why is that a big deal? Apple's selling billions of phones. Well, because they've only been around a year, maybe a year and a half. So yeah, that kind of penetration is really big. Okay. From John Connolly, French President Macron encouraged his citizens to have kids. Yeah, well, versus just pets. Well, France needs it. France has always played second fiddle to Germany. And if they want to grow and be a world power and stay in the top 5, 6 global economies, they're going to need people to do it. So he's smart to do that. So OpenAI is aiming to use this popular chat GPT to get individuals paying for it and then use that to leverage to get into business products, okay? Aiming for companies with 100 employees, companies with less than 100 employees, different lines of availability of threads, they call it, on an AI object so that you can pursue and do this, but they're trying to get revenue from it. Now, it's interesting to me that it took the internet about 5 years before any significant revenue was generated because people just wanted to get out there and have a footprint. They wanted to have, be aware of the internet is even here. Well, of course, we're aware the internet is there now. So the ramp up time for market penetration, I think, is happening quicker with AI than it did with the internet. So OpenAI doesn't disclose the number of businesses that will pay for its services, and I mentioned that to you earlier, but it did say 92% of Fortune 500 companies are using ChatGPT in some form, and 100 million people actively use it on a weekly basis. I am certain that the internet is at 100 million users, but it wasn't that for at least the first 15 years. Now, a whole lot has happened since then, so it's not really apples and apples. It's more like apples and oranges. But the acceptance and the curiosity and the thirst for what AI can do, since we just started talking about it, and one of our viewers tonight is the one who said, you really should do a segment, thank you, Larry, on AI. And of course, now we're doing it for a year or so. So thank you for that. But here we go. I think that you're going to see more and more happen. This is an interesting take. So look at the two pictures, the one on the left and the one on the right. All right, just kind of look at it for a little bit. You can read the caption. And what do you see about it? All right, so what's interesting here is they are using AI to make her look, how do I say this, less refined. Notice she has some wrinkles on the right side picture. They got rid of the necklace, okay? She has some little bit of a mark over her left eyebrow. All right, they're just trying to make her look more human. All right. That's really clever because this is the first time that I've been able to talk about this. So why is this important? Because now AI has reached the point where it's like, okay, we can create something perfect, but now people are rejecting perfect because they're used to looking out there in society and they don't see perfect. So now we need to start with perfect and then make it imperfect so that people accept it. This is just happening in a few months, folks. It's pretty cool, I think. So anyway, thought you might enjoy that. So our investment methodology and performance, et cetera, et cetera. So here we go. You guys know our programs. I always have this here though. So anyone that's new for the first time, these are our 5 programs. It's been a good year. It has been a good year. Those are the minimums. 2 of them, Spec Op and DS, require an actual conversation with me. They are very aggressive and all have required minimum openings, etc. So at any rate, we'll get into that a little bit more, but I think you guys know that by now. You can always go back and watch. I love this. This was sent to me by one of our viewers. Life can only be understood backwards, but it has to be lived forwards. Well, actually trading is the same way. Can only be understood when you look back and go, oh, that was the high of the market. That was the low of the market. That's what happened when the Fed decided to drop rates 50 basis points when everybody was expecting nothing. You know, you can go back and see the amount of volatility and analyze the VIX and the vol on the 10-year Treasury, et cetera, et cetera. But you got to place your bets on the front side. You do. And that's what makes it tough. So this is CG. I'm pleased to say that this is actually not right because we had a phenomenal day today. And I'm going to show you why in just a minute. We're now over 20% on the year, and the S&P is at like 9 something. Okay, so it doesn't happen this way every year. And those of you that have been with me for a long time know that is the case. Now, what I'm trying to do is pick stocks correctly, excuse me, on the upside, and then really work on the risk management on the downside. And that's what we've been doing, and it's definitely paying off over 2022. Those of you on this call, I see them there. I know you guys have been with me a long time. 2020 up 62%. I don't see that happening this year, but who knows? But then the secret is, all right, what are we going to do to protect the downside? Well, we have a really good plan in place, and I've talked about it on other shows. I'm not going to do it tonight. If you want a phone call or something where I explain that to you, if you're a customer, if you're just one of our viewers, I'll be glad to spend the time and explain our risk management strategies. So CG has lagged the S&P just for a few days this year, but right now it's killing it, again, over 20%. As of today, you don't see it right here. This is GI, also having a really good year. GI is only 60% stocks. Okay, so I'm sorry to laugh, but I mean, it's how do you beat the S&P every single day? Look at the blue line; it's never below that. We just had some real good picks. I wish I could say it was brilliant. It's not. It's just there's been some luck involved, and we limit what we risk. Now, you guys have seen this before, but this is what gets applied to each of our programs. So I've highlighted what's important here. We have so those of you that have been with me a long time know that I was a discretionary trader, and there's always discretion in trading. But we would get together in a room with 4 of us and beat things around for 3 hours and say, we have to buy this. No, we have to sell this. No, we have to buy this, blah, blah, blah. And I'm sure there's still some companies that do that. But right now, there's just 2 of us. There's Matt and me, and there's Tom Basso, who is a consultant, who's a great, mega successful trader, but I interviewed twice on past shows. Go back and watch those if you want. And he has helped me with my risk management strategies, which have really come to life and played out here in the last couple years. But our biggest profit, and this is just for CG, by the way, the other programs have this too, biggest loser. So you can see, obviously, the biggest profit is way larger than the biggest loser. Well, so then we want our profit to loss ratio to be really strong, right? Well, this is never going to be 5-to-1. There's not enough people to take the other side of the trade. But Tom has always said, if you get to 3.0 and can keep it there, well, we just crossed 3.0. I just had already done this graphic, but once we sell Alpine tomorrow, because the merger's already been announced and now the price is just locked in until the company essentially dissolves into the acquirer. All right. Our winning percentage doesn't really change that much. I know you must get a little discouraged when you see this. How can you only win with 1/3 of your trades? Well, if a batter in baseball bats .343, they're getting $30 million a year. You know, I don't even get 1/3 of that. I don't get anywhere close to that. It was a joke. All right, but the point is that 1/3 of our trades are winners and 2/3 of our trades are losers. But we cut the losers fast and move on. Biggest profit, 88%. Biggest loser, 35%. Really? I thought you said you only risk 1%. All right. So I'm going to answer that question. That came in from a viewer, maybe the most astute question, because I figure you guys are watching it, but maybe not following the math. But this particular person said, I was watching that slide. And actually, this is still our worst loser. So it was last month's show or maybe even the February show. And said, can you explain that? So now I'm going to answer that in the Q&A section tonight. So you might look at this, and I know we're running a little long, guys. Sorry, I'm hanging here. I want you to see this stuff, though. So what happens when you jump the gun? I'm looking at all our stocks, and I'm looking at the top 4 or 5 winners, and I'm thinking, man, those look really good there. Dell, Vista, these are tech companies, Western Digital, Micron, Raytheon, Defense. This is great. There's the S&P in yellow. It's about the middle there. I'd love for the S&P to be below everything because it means I'd be outperforming the S&P with all my picks. That never happens. But look at the bottom. Alpine. Now, if I were getting emotional, I think it's behind my logo there, but you just have to trust me. That was down 11% in 1 week. And I could have just gotten emotional and said, no, I'm not going to stick in here. I'm going to break my rules because I just don't like 11% losers. That's just ugly. I want out. I want out now. Well, it's a good thing I didn't because this is what happened on Wednesday. At 11:30, you see that huge green bar? Rumors hit the trading floor that they were going to be acquired. And so they finished the day up 21%, 20.8%. See that on the right side? In the evening session, by 8 p.m. Central, they were trading at 64, up 36%. All right? Look at that bar. Okay? You see the red bar in front of the monster green bar? That's when, if I'd gotten emotional, I would have gotten out of the stock. But it was still trading in the channel, and I said, no, I just pulling back. And now because of that, you guys that are in CG, which is pretty much everybody, are going to have this enormous gain when we sell tomorrow, because or maybe Monday, I don't know, but certainly pretty soon. Because again, once a stock announces a buyout and the buyout price is set by the acquiring company, there's really no place for the stock to go. So it's kind of dead money, and you just take it and say, thank you very much. All right. So this is DS. So DS is the Mag 7 stocks. All right. And Mag 7 has just not done great here. Look back at the beginning of the year. You can see how it was outperforming the S&P in late January, mid-February, went above it again in March. But Tesla's just really killing us, and Symmetrics has too. Apple has not helped us. But still, again, let's look at a 6.5-year track record. In fact, we're closing in on a 7-year track record in September. 286%. There's a side of me that really hopes that this is going to be a 300% return over 7 years, because that, you can look at the blue line. You know, this is an actual account from Interactive Brokers. So why wouldn't you just put everything in DS? Some people say, all right. You can't do that. Look at the drawdown, this massive drawdown from September 21 almost to September 22. And if you'd invested in the top and had $1 million in it, or even $500,000, you wouldn't have been able to sleep. So we require that the most that any of our clients can have in this is 8 to 9, not even 10%. I have about 14%, but that's because I watch this every day. All right. But should you have some in there? Depending on your objectives, I suppose. But the great thing about DS is there are no stops. There are no money management strategies. And I say it's great. It's not good for your retirement, but it is good for a speculative program as long as the size is monitored. And here's why. You look on the left, this is what the S&P has done since 1993. All right, you invested $1,000 and it goes up over to $18,000 in that amount of time. That is a great return. But during that time frame, you had to suffer through, look at these drawdowns. Minus 48% in 2002, I was there. Minus 56%. We never had that, by the way. Those of you that have been with us since the early 2000s know that our worst drawdown was 38%. But Warren Buffett was down 56%. Okay? But if you could stomach that, then you ended up with that return. This is using money management strategies. In other words, the market goes down, you take stops. I'm not going to go into the specifics of how that works, but you'll see that the overall growth drops to about 12%, or at least it's on its way back to 12%. And yet the drawdown in 2009, in fact, 2000, it wasn't even that bad. In 2023, it was pretty bad. Okay. And we were definitely in that range because we've refined our money management strategy since then. But the point I'm making is, for the preponderance of your money, you need to have an all-weather strategy. You need to have a system where you get out of the market when it's just really doing badly, and then you have a signal to get back into the market. And that's what we have for CG and GI. We do not have that for DS. We definitely have it for Spec Op. Okay. And the ETF program just kind of stays in. It's really just for small accounts. So it's very easy to handle a 50% drawdown if you're guaranteed of a final positive result. Well, who's guaranteed? That's the problem. You can say it's always going to come back. Well, it always has. But have we ever had this much debt as a country? Have we ever had this whacked out a political situation or been at the verge of World War III for quite a few reasons here? Could it be Israel and Iran? Could it be Ukraine and Russia? Could it be all of the above? You know, I can't just say, well, I'm not just going to use my intuition because it ends up being intuition, all right? But logically speaking, if you can stomach a big drawdown, then you should have some of your money there. But I really mean you've got to be able to handle it, all right? So buy and hold does make more money historically, but it's not going to be the case in the future, I don't think, which is why we have a variety of programs. If you say, I don't care about the volatility, and you can convince me that I want to put my fiduciary responsibility on the line, then there you go. Past performance is no guarantee of future performance. That's really, really important. Okay, these are questions that came in. These are questions that came in. This survey, I'm just putting this up on the screen, so you guys are going to get this in the mail on Monday. Fill it out. We'll get the response, and then I'll see your questions for next month's show, okay? So on your trade matrix, you show a loss on your biggest loser at 35.5%. I thought you said you never risk more than 1% on any one trade. What's the deal? That's a good point, but you misheard me. I don't care if it's a 35% loss on a stock, as long as the risk to the portfolio is 1%. Because there's obviously going to be more volatility in a $300 or $1,200 stock than there is in an $8 stock. Okay, if an $8 stock goes to $4, that's a $4 move, but it's 50%. Okay, so we are basing everything on portfolio risk, not on individual asset risk. But it's a good question. All right. Anyway, how do we do this? You guys saw again the NASDAQ closed at lifetime high. That's just amazing. What does the future of AI look like? Well, of course, I said that tonight. I think the industries that are going to be most affected are healthcare, manufacturing, customer service. Legal, that's something that's not being said. If I had a child going into college right now and they wanted to be a lawyer, it's like, yeah, really? Are you sure? I don't know. What are the concerns? Regulation, data privacy, job losses. Not so much job losses from within the AI community, but from the displacing of traditional workplace jobs. And the last question was, can AI help with cybersecurity? And if so, how? Well, cybersecurity is always going to be with us. It's going to be continuing as the crooks get better and sharper. We need ways for systems to react quicker and quicker and shut down and stop access, reducing the time to detect these intruders. And the companies that do this, and some of these may be the Nortons or the Bitdefenders of the world, but obviously at the institutional level, they're bigger players that none of us even hear of because they're white labeled and they don't even want you to know who they are, right? So it's the tracking of network behaviors that I think makes such an important point here. So that's where I think AI can really make a difference. And I'd love to hear your opinion. Feel free to comment on this. So there you go. Those are our topics. Hope we covered what you guys wanted to hear tonight. Let me make sure I've covered everything here. U.S. is actually one of the countries. Yeah, I saw it on Hussein and John, French president, got that too. I don't see anything new since I've commented on them. But just type them in the chat anytime. Fill out the survey, send that. So Next show, Tuesday, May 9th, right here. Don't miss it. Tuesday, May 9th. We will be here. We'll be in the midst of a huge earnings season, and you will not want to miss that. Tell your friends. In summary, as we always close, for we have not been given a spirit of fear, but a spirit of power, love, and a sound mind. We've been blessed, folks. We do live in the greatest country in the world. We have a little bit of population growth. Other countries, people are leaving as fast as they can. Now, the interesting thing is that we have states where people are leaving, but they're not leaving the U.S., they're going to other states. So this is sort of a complex immigration right here within the walls of the U.S. But we've been blessed by being able to freely cross borders and states and go wherever we want to go. And if you want a job in America, you can find one. So I hope you guys are doing well. Hope this was useful for you. I appreciate you watching. I appreciate those of you that are clients. We got new viewers from LPL tonight. We appreciate you guys being here. We're here to help. We're here to give you confidence that the data that I'm telling you is accurate. It's double sourced. You have questions on it, let me know. But don't let the corporate media bring you down, discourage you. The best of times still lie ahead for America. I tell you that every month. I mean it every month. God bless you guys. Thanks for being here. We will see you next time.